Most investors don't lose money because they choose bad assets. They lose money because they make decisions at the wrong time. They buy when things feel safe and they sell when things feel scary. And this happens even with the best assets. Let me show you how. When investors lose money, they usually blame the assets. They say this stock was overhyped, gold is better than stocks, markets are manipulated. But very rarely do they ask a more important question, which is what was my mindset when I invested? Because market don't just test money, they test patience, fear and discipline. There is very common belief in market. If I buy good companies or good mutual fund, returns will come automatically. Sounds reasonable, but here's a simple example. Two people invest in the same index fund. One starts investing after a long bull run when markets are hitting new highs. News channels are positive and everyone is talking about returns. The other invest when markets have been flat or negative, SIPs feels boring and people are questioning equity. Same product, same economy, very different results. The difference wasn't intelligence, it was timing and behavior. When market rise, demat account opening increases, IPOs are oversubscribed, social media fills with profit screenshots, relative starts giving stock tips. At this stage, investing feels safe and exciting. Many first-time investors enters here not because valuations are attractive, but because confidence is everywhere in the market. Now look at the other side. When markets fall, headlines talk about uncertainty, SIP stops, people move to FDs or savings. Gold suddenly feels safe again. At this stage, holding equity feels uncomfortable. So what happens? Investors often increase equity exposure near highs, reduce equity exposures near lows. In simple words, buy confidence, sell fear. This behavior explains most long-term underperformance. Market cycles repeats the same story. Different decades, different reasons, same behavior. Markets moves in cycle, optimism, excitement, euphoria, fear, panic, despair, recovery. And here's an important observation that I have observed. In market, retail participation peaks near market tops, patience peaks near market's bottoms. Prices moves faster than emotions. That gap is where mistakes happen. Let us take a very important scenario. When equity markets do well for years, gold feels useless. People say gold gives no return, equity feels like the only smart choice. But after sharp market corrections, interest in gold suddenly returns. People talk about safety and protection. Asset allocation starts making sense again. Same asset, different emotions. Sixth Sense investing observes this rotation of emotions, not headlines. Sixth Sense investing is not about predicting crashes, catching exact bottoms, trading every move, chasing the latest theme. It is intuition built on understanding in market cycles, recognizing crowd behavior, respecting risk when returns look easy. For example, when everyone around you is confident about markets, sixth sense investing asks, what is the downside? When market feel boring or scary, it asks, is risk already priced in? Before investing, ask yourself, first, why does this feel comfortable right now? Is it because prices are rising or because everyone agrees? Second one, what happens if the next 2 years are flat? Can I stay invested calmly? And third, am I investing for returns or for emotional relief? These questions alone can prevent most investing mistakes in India. Successful investors are not the fastest, the loudest, the most active. They are the calmest. Calm enough to continue SIPs when news is negative. Calm enough to avoid over allocating at euphoria peaks. Calm enough to balance equity and gold rationally. That calmness is the real edge. If you want to understand market beyond headlines, If you want to recognize cycles before they become obvious, and if you want to invest with clarity instead of emotions, welcome to the Sixth Sense Investors.